Hello friends and welcome to North Star Wealth, where we discuss everything about personal finance and money management. I am Mahendra Rao and today in this video we will be talking about different types of mutual fund scheme in debt category. In the previous video we have talked about debt mutual funds, and now in this video we will be talking about the different categories of debt mutual funds. Many investors understand that mutual funds are only related to equity, but no investors have ever looked towards a debt mutual fund. Only they have invested or understood equity as a mutual fund scheme. So in the earlier video, if you want to understand about debt mutual fund, you can go and watch that video, and in this video we'll be talking about the different category of debt mutual funds. So let's find out different types of schemes in debt fund category. So with this information you will be able to understand debt mutual fund much better and the categories in which debt mutual funds are available. So debt mutual fund is basically divided into two categories. Basically, one is on the basis of duration and the other is on the basis of theme. Duration, as per the name suggests, is on a time horizon basis. If you go and book a fixed deposit in a bank, you get different horizon with different rates available, right? There are different FDs available for different tenures, which will provide you different rates. So accordingly, SEBI has categorized mutual funds also on the duration basis. So the durations are overnight funds, liquid funds, ultra short term funds, money market funds, low duration funds, short term duration fund, medium duration fund, medium to long term duration fund, and long term duration fund. So these are basically divided on the basis of horizon, which is time. So for how long you want to invest, accordingly you can choose a fund from that category and invest into that particular fund. So it has become very simple. SEBI has made it very simple for retail investors to participate into debt mutual funds by identifying these funds through the time basis. And then there is another funds which are available on the theme basis. Then there is a dynamic bond fund, corporate bond fund, credit risk fund, banking and PSU funds, gilt funds with 10-year constant duration, floater funds, and fixed maturity plans. So here there is no duration available, and these are all theme basis. Let's discuss out how this funds are floated out. Right, if you see on the horizon and duration based debt funds, the first category is overnight fund. So this fund will invest in debt securities which have a maturity of just a day. So if I want to invest in a fund which maybe for the next 3 days, 5 days, 10 days, I can park my money into overnight fund. So these are considered very safe investment, just like savings bank account. If I have a huge chunk of money that I am keeping in my savings bank account, but I don't want to keep in my savings bank account and invest here to earn that extra returns on that fund, I can park my fund in an overnight. So there are funds available for a single day with the maturity of having just a day. I can park my fund here. Liquid funds are debt schemes that invest in debt securities with a maturity up to 91 days. So if I am looking for an investment from 7 days to 91 days, I can look towards liquid fund. So this fund will invest in treasury bills and commercial papers, and these are very high graded debt securities papers with a very short maturity. So the risk is very low and the yields are also low. So low risk, low returns. So here the risk is very minuscule and the returns are pretty much better than a savings bank account. So here you have an opportunity to invest into a liquid fund to earn better rates than a savings bank account. Then there are ultra short term funds. In this fund, the fund will invest in securities with a Macaulay duration of 3 to 6 months only. So this fund will provide you a better return than a fixed deposit, short term fixed deposit, because the horizon is for 3 to 6 months. So now if you are looking to park funds for next 3 to 6 months, this is the fund you can opt for. You can avoid investing in a liquid fund, but you can invest in an ultra short term fund if your horizon is 3 to 6 months. If your horizon is less than 3 months, you should be parking your fund in a liquid fund. Right now there are low duration fund. Here the Macaulay duration between 6 and 12 months. The debt fund will invest in debt securities with a Macaulay duration of 6 to 12 months. Now if you want to park your money for next 9 to 12 months, this is the fund you can opt for. Here the duration is little higher, but for the duration it becomes more riskier, right? Because you do not know what will be the rate of interest at that point of time, right? The more the duration, the higher risk it will carry in any particular debt mutual fund. So these are considered a less high riskier than ultra short duration fund. If you want to park your money for 6 to 12 months, this is the fund you can opt for. And again, there are money market funds with a horizon of up to 12 months. They invest in these are open-ended funds which invest in money market instruments with maturities of up to 1 year. These money market instruments are what? They are cash, they are treasury bills, and these are commercial papers. So the fund will invest into this particular category having a maturity of up to 1 year, right? So low duration and money market, low duration will have 6 to 12 months and money market will have not less than 1 year. So it will be 365 days predominant, right? Now you have short duration fund. If you have a horizon of 1 to 3 years, if you want to invest money in a low risk investments and the horizon is 2 to 3 years, then you can choose to invest in a short term duration fund, because this fund will invest in government bonds, debentures, corporate bonds having a maturity of 1 to 3 years, anywhere between 1 to 3 years. Because when you talk about a debt mutual fund, it will have a portfolio of securities. It will not invest in a particular security, right? So they will buy corporate bonds, they will buy government bonds, they will buy treasury bills, they will buy debentures with different horizon of 1 to 3 years, right? Now there are medium duration funds. If you want to invest in 3 to 4 years but do not want to take risk in equity, then there are funds available where you can invest in a medium duration funds which will have a Macaulay duration of 3 to 4 years, right? So we have to understand these are all duration which are calculated and then invested into that particular papers, right? Then there are medium to long duration. If you are willing to invest to 4 to 7 years, then there are funds available where you can invest in a debt mutual fund. If you don't want to take much risk by investing in equity, there are funds available that you can invest through debt mutual funds. Interest rate risk is here. These funds carry high interest rate risk because the duration is long. If you talk about 4 to 7 years, the lesser the duration, the lesser is the risk. Lesser is the risk, the lesser is the return, right? So here the horizon is 4 to 7 years. So you are opting to take a higher risk by investing in papers or bonds or securities which are 4 to 7 years. The risk is high because we don't know what will be the interest rate scenario down the line, 3 years, 5 years, 7 years. I know what will be the interest rate in the next 3 months, 6 months, or maximum up to 12 months. So if I go beyond 1 year, a risk gets added, but the risk is benefited by the returns which it provides. So interest rate is the risk that increase in interest rates in the economy will reduce the price of the fixed income securities. Whenever there is an increase in the price in the interest rate, the price of the bond decreases. These are inversely proportional. So as the interest rate rises, the bond prices will start falling and the NAV of the debt mutual fund will also fall, right? So this will impact your returns on the portfolio, right? So whenever you are looking for a longer duration, you have to understand the risk and then invest. And then there are long duration fund. If you want to invest for more than 7 years in a debt mutual fund, there are funds available for a horizon, for that particular horizon, right? And since this fund invests in securities with longer duration, they carry higher risk than the funds mentioned above. Any fund above this will have a lesser risk, and this will have the higher risk because the interest rate is uncertain, right? If we talk about theme based, so this we have covered the duration based funds on the basis of 1 day to 10 years. I have different funds available for different duration or horizon where I can park my money, invest my money and generate returns on that portfolio. Just like whenever I enter into a bank, I have different options available to book my fixed deposit. In debt mutual fund also you have funds available for different investment horizon, and depending on the investment horizon and the interest rate cycle, you will be benefited accordingly. Now there are a different category of fund available in a debt mutual fund, which are theme based debt funds. So theme based debt fund will not look into the maturity of the papers, but they will be having a broader portfolio investments across categories and across time horizon. The fund manager will try to generate better returns by investing in a 1 day paper to a 10-year paper anywhere he can invest in, including a AAA rated bond or government securities or money market or low duration papers or treasury bills, anywhere. But it will be very much defined by the theme of the fund. So the first theme which category which is available is a dynamic bond fund. Dynamic bond fund will invest in debt securities across durations. We do not have that restriction of investing in a particular duration only. Earlier category there were restriction to the duration, the time. So fund manager will invest according to the prevailing interest rate cycle in the market, right? And for instance, if a fund manager expects a fall in the interest rate, they will go for a longer duration in the portfolio. And if the interest rate cycle reverse, they may rebalance the portfolio to shorter duration, right? So accordingly, they will manage the portfolio of the debt securities. Now there is another category which is a corporate bond fund. So as per the name suggests, the fund will invest predominantly into corporate bonds only. So while all the funds mentioned so far invest depending on the duration of the debt securities which we discussed, this fund will invest in credit rating of the securities. So 80% of the investment will go towards AAA rated bonds, and which will provide you good returns compared to any other debt fund. You should always check the credit rating of the corporate bonds from the portfolio of the fund you are invested in. So you have to always check the corporate rating, what is provided to the fund, and how much allocation has been done towards the corporate bond funds and what ratings is provided to them. Accordingly, you can invest your money into the corporate bond funds. So 80% investment will happen only in corporate bond funds, and the rest 20%, the fund manager can take 100% call of investing in corporate bond funds. Maximum allocation allowed any given point of time is 80%. So there are credit risk funds which are available. So this fund, as per the name suggests, have a high credit risk funds. So these funds invest 65% of the total fund money in the high rated corporate bonds. Since their ratings are lower, these bonds pay higher interest, right? So apart from triple rated, they will go for a AA plus, AA minus kind of a bond, which has a lower rating and high interest rate, right? So investors who want to invest in a debt mutual fund and want to take a higher risk into the debt fund, they can always offer a credit risk fund. So here the fund generates double-digit returns in the portfolio. So if you are taking a high risk, again it is a high return game. So here in debt mutual fund also you have that opportunity, you have that facility available that if you want to take high risk, you can make good returns on the debt mutual fund. Another category, which is the banking and PSU funds. So this fund will invest only in debt securities of banks as well as PSUs. PSUs are public sector undertakings, so government companies. So this fund will invest 80% of the total fund money in debt securities from banks and public sector undertakings. So here the risk is a bit low, but the returns deviate because the fund manager can invest across different horizon of bonds, right? From 1 day to 10 years, he can invest across durations. So this is one theme which is available. If I don't want to take risk, here the credit risk will be very, very much less, because for a bank to default or a PSU fund to default is a high, very less probability, right? So there is one category which is available in a theme-based debt mutual fund. Then there are Gilt funds. As per the name suggests, Gilt, it invests predominantly in government securities only. Any given point of time, 80% of your money will be in Gilt fund, and this will be across duration. So there are government securities which are available for 3 months. There are government securities which are available for 3 years. The fund manager will invest across categories basis on the interest rate cycle which he feels, and will keep on actively managing the portfolio and generate better returns for the investors. So, but the basic securities will be government securities only. And then there are Gilt funds with 10-year constant duration. So here any given point of time will be papers which will have a 10 years constant duration. So 80% of the funds will be invested in government securities. Being a Gilt, it will have government securities only, which will have a constant duration of 10 years. So interest rate of this fund is fairly stable because there is a constant duration. I have to hold the portfolio till maturity. I cannot do any active management in between. So my returns are very much secured, and I will be able to generate fair returns out of this. Then there are floater funds available. Now RBI has floated floater funds because the interest rates are not fixed. So there are funds available. If you want to avail the opportunity of the interest rate changing, you can invest into this floater funds. So there are funds which are available. This is a category which is available. This will invest across floater funds which are available in the market and invest into that securities. So they do not give you a fixed coupon. Instead, their coupon is linked to a benchmark. RBI floating bonds, it is NSE ka rate plus 0.35% ka spread. So RBI's floating rate bonds are linked to National Savings Certificate, which are reviewed every quarterly or half yearly, and then the rates are changed, which are available as per the market rate. And there are fixed maturity plans. These are the funds which are available with a fixed maturity. Earlier, it used to come with a 3 years horizon, less than 3 year horizon. But nowadays, as per the taxation benefit, this majorly comes for more than 3 years horizon, 1000 days, 1200 days, 1400 days, 1500 days, to avail that taxation benefit. And these are the funds which are fixed in tenure, and it will be only available after maturity, and these are tradable in the market, but the liquidity is quite low. So in this video we have understood what are the different categories of debt mutual funds. So these are duration based and then there are theme based. So we have understood the funds which are available on a different durations and the funds which are available on a different themes which I can invest. So through this video you will be able to understand debt mutual fund well, and if you want to allocate your money towards debt mutual fund, you can opt out of these funds. Thank you so much guys for listening. Signing off, Mahindra Rao. Until we meet again. Bye bye.